Welcome back to the Graham Stephan Show, and we got to talk about the housing market today because the reality is buying a house is near impossible in today's market. There's very little inventory, there's a lot of competition, and mortgage rates are the highest they've been in decades. And so with that, I want to comment on this video. It's titled, Why Buying a House in the US is So Hard Right Now by Vox. So with that said, make sure to hit the like button, subscribe, because that helps the channel tremendously. And now that said, let's begin.
When you buy a home in the US, there is a basic promise that home values will go up over time. And that is what you're seeing on this chart. Let's adjust it for inflation. Okay, jerkier, but still basically goes up.
Now, here's the thing you got to consider along with this is that not all areas go up in price. I started looking at a lot of these areas throughout the Midwest. Because, recently I'm looking at these properties throughout the West Coast and some of the more expensive areas, and I'm looking at it and I'm thinking, these properties don't cash flow at all. But you buy them because you hope that, even if you break even, the tenant pays the rent essentially, and you're able to use that rent to go and pay down the mortgage, and then after 30 years, you get to own the home outright, and then by then it's 10x in value. That's the hope. But, a lot of those properties don't cash flow. So if you have to look throughout the Midwest, and in those areas, yeah, you'll be able to get some return on your money, but then you look at the values. And I saw some properties there that they bought them in 1995 for $70,000, and they're worth $80,000 in today's money. It makes absolutely no sense. These property values have not gone anywhere. So yes, this is true overall, but we also have some factors contributing to this that people don't consider. And that would be the fact that our population has grown since then. There aren't as many houses being built, so there's less supply, and more people, less supply is causing prices to go up. Will the population continue to grow at the same pace that housing is, not being built? And that in the future, I don't know if it's as guaranteed as they make it seem to be. And now I'm bullish real estate long term. I like real estate. I have a lot of money invested in real estate. But I want to say a bit of word of caution here that housing is not always going to go up for the fact that it's always gone up so far. But let's continue.
If you own your home in the US, you own an asset that is appreciating in value. It could be collateral if you ever need money, like to start a business or to send your kids to college. One day you might sell it for more than you bought it, but also stability.
This is true. Now, someone told me, or I saw a quote, it's probably on Twitter, that buying a house, your mortgage is the least that you're going to pay every month, the lowest. When you're renting, the rent is the most you're going to pay in a month. Very true, because you don't just have a mortgage. People love to compare a mortgage with rent, and they say, the mortgage is only $200 a month more, but I get to own it. Okay, sure. But what about property taxes, insurance, repairs, maintenance, all the other things that go along with that? There is, however, the one benefit that I've noticed 100%. There is a quality of life that you get with owning a house. Now, assuming you're not just owning it for a year and then moving on to something else, when you live in a house long term that is yours, you feel a sense of satisfaction and pride over it that you don't quite get with renting. But, in a lot of cases with renting, you'll end up saving some money because the cost per month is going to be lower in the short term.
But the barriers to buying a home in the US are getting higher. So how much higher exactly? So first, let's go back to the median U.S. housing price over the past 50 years, up to 2022. And now add income onto it.
The reason for that, by the way, is almost in all cases, it's zoning, and the cost of building is increasing. So you have inflation from materials. Think, lumber, steel, wages are going up. So for plumbers, electricians, architects. So a lot of these trades are costing more money at the same time that material is costing more money. At the same time that zoning is getting harder and harder to build. So when you're a developer and you think, I could develop a $200,000 home, or I could just go over here and build a $2 million home for, I don't want to say a little more work, but your ROI is going to be so much greater for developers on luxury properties than it is on the run-of-the-mill average house. So that's why you see a lot of developers, if they want to maximize how much money they can make, it makes sense to build luxury units, luxury houses. The bigger, the better. And of course, it's going to cost more money. You also have to consider, because I love digging into the nuances with this, because a lot of people, they look at charts like this and you're like, home value prices go up. But they also don't know that the size of houses is also increasing alongside with it. So when you look at the 1950s, most of these houses were 1,000, 1,500 square feet. So their price is going to be a lot lower than the average house today, which is 2,500 square feet. It could be 3,000 square feet. For new constructions, see a lot of them now coming in 3,500 square feet, 4,000 square feet. So we are getting more square footage, which is costing more money to build, and obviously that price is increasing. I think it would be a lot better, perhaps, to break down or do some sort of calculation between the cost per square foot relative to income in certain locations. Like that might help narrow it down a little bit. But also you get the cost per square foot generally goes down the bigger you build because you have scale. But anyway, there's a lot of nuance to this.
Median income, median home price. This house is more than 6 times this household's income. So that is what we're looking at when we go back to that chart of income and housing prices, again, adjusted for inflation, and compare this gap to this gap.
Okay, let me stop there. They need to build more houses. I don't know why people want to make it so complicated. They need to build more houses. And now who's they? Developers. Why are developers not building enough houses? Well, cost and zoning. That's what it is. So the cost, that's going to be hard to bring down, but you can, I was about to give you the finger, cost, zoning. You can help with zoning. And a lot of that is local restrictions at the city level that make it impossible. They make it very difficult. So many hoops to jump through for developers to build a property. Now, I'm not saying we get rid of all zoning regulations, but if we open it up, if we allow more units, on average, more housing units will help decrease the cost, and if builders are able to build more inventory will help bring down the prices. There might also need to be some sort of subsidies or something, some sort of incentive to make developers build smaller properties that could be perhaps more affordable. Now, of course, they're going to say, well, if I'm building a property, I may as well just maximize it because building a smaller home does nothing for the bottom line. I could, add more square footage and make more money for very little more work, very little more work. I'm talking horror. I'm so tired this morning. I was up unbelievably early. So I'm doing my best here, okay? But anyway, if we relax zoning, I think that should help. And there's probably got to be some sort of incentive or some sort of tax structure or some sort of maybe structure that would be better for developers. Like, let's just say, okay, I'm just throwing stuff at the wind here. Let's just say a developer doesn't have to pay tax on the first $500,000 of profit if they go and build a house. Well, if that were the case, developers would start building immediately. Or imagine that the profit that they make would be payable, every year over 5 years. So if you make $500,000 in profit, and your tax is $100,000, you just split that $100,000 over 5 years, pay $20,000 a year. It gives them more capital to go and work with instead of just, paying the IRS. So there's got to be a larger structure in place here to really help solve the issue.
Zoning laws that regulate things like where homes can and can't be built, how many units a building can have in it, and how densely housing can be built. It leads to fewer homes getting built, which leads to fewer homes to buy.
Why don't I just say, guys, you can just listen to me. We don't even need to watch this video. And now, here's the thing, okay? As someone who's lived in Los Angeles for my entire life, moved out in late 2020, haven't been really back there, but I still own some property there. Now, I've seen it firsthand, and I get the arguments, okay? Let's say that you buy a single-family home. You've saved up your entire life, or you've inherited a property, or you bought the property in 1990, and now it's worth $3 million in a nice suburban area, all single-family homes. You don't want a big apartment complex being built right next door to you. You lose all of your privacy. All of a sudden, there are people looking in on your backyard. More, the street becomes busier if you have 30 units next to you. Imagine the street traffic, the people going in. I understand it. I get it. I get the argument on that. But, they make it difficult. Now, what cities like Los Angeles have tried to do is allowed you to build an ADU, which basically says if you have a garage on the property or you have space in the back yard, you're able to build another 1-bedroom or 2-bedroom unit, depending on the size of the property, and then you could rent that out. And that's to help, ease some of the housing affordability issues because people aren't able to buy it, but it adds more inventory in the market that you could then rent out. I think it's a great thing. However, the downside is that single-family homes in Los Angeles County, I'm speaking just to Los Angeles here, okay, are not rent controlled. That means if I own a home in Los Angeles and I want to rent it for $5,000 a month, I can't. When the lease is up, I could say, hey, the rent is now $7,000 a month. And they say, oh, I can't pay that. And I say, oh, you got to leave then because that's the market value. And, I have a hot commodity here and I want to maximize what I'm able to get for it because that's what it's worth. If you build an ADU on the property, now all of a sudden it's classified as multifamily, and that means it's rent controlled. So you have a lot of homeowners that just say, I would build an ADU. I would love to spend the money. I'd love to add more inventory in the market, but I don't want to because now my entire property is going to be rent controlled, and if I rent that out, I'm not going to have as much control and versatility as I would just a single family house. It's holding some people back. So I think they really got to lax a lot of these things. The other thing is we can make a lot of arguments against rent control as well, but rent control also restricts the supply of housing on the market because it only rewards the people who have been there for a long time and don't move. It doesn't help the people who want to move into a location. It only helps people who just got lucky, who rented the spot in 1995 and now the rent's $700 a month, whereas, the market value might be $6,000 a month or $5,000 a month, whatever that might be. So rent control, I don't think is the best solution. I think easing up zoning, great, but there's no way to make everybody happy. You're gonna upset somebody, and that's just got to be the collateral damage.
Housing in the U.S. is scarce and it's expensive, but we're actually missing a really important piece of the story here. We'll talk about that after this quick message.
All right, they're doing a sponsor here, so how about this? I don't have a sponsor on the video, but I do have a newsletter down below in the description. I post there every single week, and I take my videos and I just do deep dives. I go into a lot of analysis, including real estate, by the way. So if you want to be a part of it, I'm not spamming you or anything like that. It's just a newsletter. I figured it would be a great way to provide value and expand on the topics that are sometimes a little too wordy or nuanced or, for the YouTube algorithm, okay? I really try to cater to the algorithm on this one, but for the email, I could blast out more information. So if you want to be a part of it, the link is down below in the description. It's totally free. It'll take you like 20 seconds to sign up. It would help me out a lot. You get free information, and there's more information on the housing market in there as well. So enjoy. Thank you so much for doing that. We'll get back to the video.
Because a lot of current homeowners have mortgage interest rates down in this range, the 3, 4, 5% zone, it means that since selling their home might mean having to buy a new one at an interest rate up here, fewer people are selling their homes. It helps keep that homeowner vacancy rate low, and it keeps home prices high.
Exactly. And that's another thing, too. Keep in mind, this chart goes back to like the 1980s. Back then, the mortgage rates were sometimes 15%, 18%. Imagine that. Of course, home prices are going to be lower because you're paying an 18% mortgage rate. It's stupid. So now people are locked in 2.5%, 3% mortgage rates. They're going to pay more. The housing prices go up, the lower mortgage rates are.
The website Zillow looks at several of the factors we've talked about, including home prices, income, mortgage rates, and it calculates the monthly burden on the average new homeowner. According to them, that burden is close to the highest on record.
Yeah, but we're really going from like 30 to 40%. Now, listen, I get that's, dramatic, but keep in mind, it's not like the end of the world where it's like, 35% is normal, but 40, okay, let me back up for a second. When I say 30 to 40%, I mean that when a lender qualifies you to go and get a mortgage, they want to make sure that the mortgage, it's called the debt to income ratio, is not more than like 35% of your income. So if you make $10,000 a month, they want to make sure 35% of that, or $3,500 a month, is going towards the house at the most. Some lenders will do 40%, some like 30%, people prefer 25%. Usually, let's go with 35%. So 35% of your income is going to housing. It's not that big of a stretch. Lenders have been doing this forever, trying to get you up to 40%. I've even seen like 42% debt to income, meaning 42% of your income goes towards your house. It's risky, yeah. But you know what? There's always going to be lenders out there who will underwrite it, who will find a way to package the deal. They want to get the deal done. So to me, that's not that big of a concern.
A home is a pretty unique kind of purchase. It's a necessity that you buy at great cost. But if you look at it as a long-term investment, it's not actually that special.
If you want the stable investment, you go out and invest in a nice, government bond mutual fund. You don't have to worry about that. It is most likely, going to go up. And if it doesn't go up this month, over time it will.
I agree with that. I went in with this mindset years ago and I thought, oh no, you got to go and buy a house. A house is a great investment. I see the appeal for it. But I would say 90% of people don't approach it with the same mentality that I do. I am fanatical. Everything that I buy has to be an investment or hold its value. If I buy something and it loses money, I feel it here for some reason. It pains me to waste money. And so when you see me going and driving a car, well, guess what? I've calculated that car and I've made sure I'm going to make money on that. Or at least, worst case, I'm going to break even and get to drive a free car. That's how my mind works. When I look at real estate, I think, how can I make money now? So I'm looking at a property, $600,000, and I think to myself, I got to figure out a way to get it for $500,000. So that way I'm $100,000 positive in the green, so I don't lose money on that deal in case the market goes down. And then I think to myself, ooh,
I could invest $50,000 fixing it up, and now it's going to be worth $700,000. So now I'm in it $550 and it's worth $700,000. I just made $150,000, and then if the market goes down 15%, then I'm still making money.
most people don't approach it like that. When I'm buying a property, I'm looking at buying it under market value, fixing it up, finding more equity in the property, renting out a portion of it to cover my expenses, and then calling it an investment, because that would be a better investment than going and renting. But when you're going and buying a single family house for yourself at market value because you want to live there, it doesn't really make a lot of sense as an investment. Okay? Now, the exception to that, why people call it a good investment, is because a mortgage forces you to save every single month. If you don't make your mortgage payment, guess what? They're going to foreclose on you and you'll have to leave and you're going to have to give up some of your equity because they're going to force a sale on the property, okay? If you rent, there's not that discipline where you have to go and invest your money every month. I would say if you're equally disciplined to rent it $1,000 a month and then spend $1,000 a month buying, an index fund, great. But if you're not, and it's spending $2,000 a month on a mortgage, probably the mortgage is going to be a safer bet if you're there for 30 years, because then you have a paid off property, you've saved up some money, and it's forced on you. So I'd say for the majority of people, buying the house is the right investment choice because it's going to force you to make that payment every month. It's going to force you to invest. And I would imagine for a lot of people, if they didn't have that forced investment, they wouldn't invest. They'd put it off, they'd skip some months, they'd wind up with less money. So that is my take on it. Let me know what you think down below in the comments section. I'll do my best to read and respond to as many of your comments as possible. Make sure to also hit the like button, subscribe, and also you can get some free fractional shares for signing up with a paid affiliate link down below in the description. I'll get a commission on that, of course, but you'll also get some free fractional shares that could be worth a decent amount of money. So if you're interested in that, check out the link down below in the description as well as my newsletter. Thank you so much, and until next time.